The decision to invest is an important one that will impact your financial future. Before you make the decision, though, it's important to know some basic financial concepts. Hi there, I'm Kelly Keene, author and personal finance educator. Let's walk through what you need to know before you start investing. For some people, investing can be intimidating. For others, just boring. There are a lot of options out there, and with so many choices, it can seem overwhelming and confusing. Investing can be a key to unlocking your financial dreams, like owning a home or saving for your children's education. Importantly, you need to rely on yourself to save for your future, including retirement, because so many Albertans, and you may be one of them, won't have a company pension plan to rely on. And buying lottery tickets doesn't count as a retirement plan. Saving for some future goals can seem daunting and very far away, but it only takes a few simple steps to get started, and the sooner you do, the better prepared you will be for your financial future. Let's start with the basics. What's the difference between saving and investing? Saving is generally short-term. It's meant simply to preserve money or set it aside to protect it for when it may be needed. Investing is generally a longer-term commitment. It's always done expecting a profit or some sort of appreciation of the amount put in. So then, why should you invest? Investing is putting your money to work for you with the expectation that it will increase in value, provide income, or both. There are three concepts that are critical to understand before you start investing. There's no reliable method to quick riches, but there are proven methods to build wealth slowly if you are patient, even if you can only put a little money away now. I'm sure you've heard of compound interest, and it really can be quite magical, but it requires time to make it work. Let's see how. Hannah invests $5,000 a year between ages 25 and 35, then stops investing. In total, she's invested $50,000 and has about $400,000 for her retirement. Justin invests $5,000 a year between ages 35 and 65. In total, he's invested $150,000, but essentially has the same amount as Hannah, even though he contributed a lot more. That's the beauty of time and a long-term perspective. The best scenario is Susan's. She invests $5,000 a year between 25 and 65 and has more than $830,000 for her retirement, twice that of Hannah or Justin. That's a much better strategy than playing the lottery. It might seem impossible to save $5,000 a year when you're in your 20s. If you look at your expenses, however, you might find some easy ways to get there. Spending $4 a day on a cappuccino at your favorite coffee shop adds up to $1,500 a year. So, think about what discretionary items, also considered wants, not needs, that you might be able to cut back on now that could add up big in the long run. The three most important elements in taking advantage of compound interest are: start early, making regular investments, even small contributions will add up over time, and be patient. A long-term perspective will pay off. Ever heard, don't put all your eggs in one basket? It applies to investing and means that dividing your money into different kinds of investments can help create steadier returns in the long run. This idea is what's called diversification. If all of your investments are in one area and that area increases, that's great. But if it decreases, it can be tough to watch all of your investments go down in value. So, if you have a variety of investments that focus on different areas, sometimes called sectors, and increase and decrease at different times, you'll have what's referred to as a balanced portfolio. The recent economic downturn in Alberta shows how beneficial it can be to diversify. If you are heavily invested in one sector or area and it loses value, it can have a significant impact on your investments and your financial future. There are so many ways to diversify, and a few examples are the type of investment, the time to maturity, the type of industry, and geography. Keep in mind that while diversification helps to minimize risk, it does not provide a guarantee against loss. That's why it's important to know the third concept, which is perhaps the most critical to understand, and that's risk versus reward. The bottom line, every investment has some degree of risk. Here's the general rule. If an investment is offering higher returns, like a stock or mutual fund, for example, there is also going to be a higher risk involved. And if the return is low, like a GIC or a savings account at a bank, the risk is low too. If you take on a lot of risk when investing, it is possible that you could lose some or all of your money. But the risk in investing in something with a low return is that you barely beat inflation. That's why you need to carefully determine the right mix for you. Not just your current and retirement needs, but also your comfort level. If you would like to know more about risk and risk tolerance, check out the other videos on the ASC website. It's really important that you look out for any investment claiming to be low risk or that has no risk at all and is offering high returns. This is a red flag of investment fraud. As the old saying goes, if it sounds too good to be true, it is. And if you're not sure, checkfirst.ca, the ASC's consumer website, has tools and resources to help you learn about the types of investment risk out there and how to assess your personal risk profile. Knowledge is power. Before investing, checkfirst.ca.